Good morning, everyone. Welcome to the Commodities and Currencies podcast. This is Manish Sharma, joining as a fundamental research analyst. So, let's start with the key events that happened last week as well as the key triggers expected for this week. Let's start with precious metals. Gold prices have traded in a positive territory in the early trade today. We have seen levels around $4050 per ounce in the spot markets, where the precious metals have been supported on concerns of US economy and the US private jobs data last week, which have indicated a weak labor market, which had also ramped up bets that the US rate cuts might be nearing in a December meeting. US challenger job cuts data released last week had indicated that there is a spike in the job cuts, suggesting a possible cooling of the US labor market conditions, where the challenger report highlighted that the companies cut over 150,000 jobs in October, marking the biggest reduction for the month in more than 20 years. Moving ahead, today's we also see one of the important event that Bloomberg has reported that the U.S. government shutdown is nearing an end, where the group of centrist Senate Democrats have agreed to support a deal to reopen the government and fund some departments and agencies for the next year. Traders have also ramped up bets that the rate cuts following US challenger jobs data last week and optimism on the reopening of the US government shutdown now has weighed on the US dollar recently, but had lifted the bullion's appeal. Market now sees a 66% possibility of a 25 basis point rate cut, according to the CME Fed Watch tool. This is slightly higher than the 60% probability which was persisting since the onset of the last Fed meeting. Gold had stabilized around the $4,000 mark in the last week, where we have seen that it started last to last week at roughly the same levels. Attempts by seller to push the price below $3,900 are meeting with impressive buying interest. We have seen that supports are persisting around the same levels, while on the higher side, we still see resistance for the prices at around 4120 to $4150 per ounce levels in the spot markets. On MCX, we do see the overall the supports coming at around 1,21,050 levels, and that was the closing for the Friday. But we see the supports at around 1,20,200 and 1,19,500 levels, which could be a buying zone for this week. On the higher side, we do see prices testing resistances at around 1,22,200 and 1,23,000 per 10 gram levels in the MCX futures December contract. Now let's move ahead. For silver prices, we see the supports at around 1,45,500 and 1,43,800, while on the higher side, we see resistance for the metal at around 1,55,800 and 1,58,000 on the higher side. Now let's talk about the base metals. We saw global equity markets correcting sharply last week, where concerns over stretched valuations and dampening risk appetite and weighing on that also weighed on the base metals. Copper, aluminium, and zinc had lost momentum after a brief rebound, while we saw the return of the lucrative US tariff trade, which drove traders to offer $500 per ton premiums over the US bound copper, highlighting persisting tightness in the physical copper despite weak macro sentiments. On the weekly basis, we see MCX copper finding support at around 990 to 982 levels, while on the higher side, we see resistance in the prices at around 1015 and 1024 per kg levels on the MCX November contract. For the outlook, we see the metals may remain under slight pressure this week as equity markets volatility and rising inventories have challenged the sentiments. Aluminium 3 months futures are testing support at around $2,830 per ton on the LME. If it breaks down below that, the opening on the downside could be near to 2,700 to 2,720 levels. However, the shift to cash to 3 month spreads into contango reinforces a softer tone for the prices. But copper, in terms of copper, we see the near-term support lying at around $10,400 per ton, and a failure to attract buying interest on dips could trigger further consolidated moves in the copper, where the bias for the week for the copper prices remains cautious, with macro uncertainty, technical weakness likely to cap some upside potential. Now let's talk about the energy complex. For energy complex, What we saw was crude oil extending its losses last week, with WTI December futures contract down around 2% to $59.75 per barrel amid mounting oversupply and weak demand concerns. US inventories have risen to 5.2 billion barrels to 421.2 million, and output had hit a record of 13.8 million barrels per day, deepening the bearish tone. OPEC modest hikes, Saudi Arabia price cuts, and softer economic data from major economies had further highlighted global fuel demand. Supports for crude oil could remain on a weekly basis on MCX could remain at around 5,200 and 5,100 levels, while on the higher side we see resistance at 5,450 and 5,550 levels. Oil prices expected for this week to trade firm in the early trading today, but may see a limited upside for the week as markets weigh optimism over the potential end of the US government shutdown, while supply glut still remains. The short-term bias remains slightly bearish, with focus on fresh EIA inventory data due later in the week and OPEC and IEA monthly reports for the demand cues. Unless a sharp drawdown or a major supply disruption emerges, oil is likely to trade under pressure. Technically, resistance lies near 62.20 to $63 per barrel levels, while the support holds at around $59.40 followed by $55.90. A break below 59.40 could trigger further downtrend momentum, keeping the markets weak throughout the week. The Indian rupee, if we talk about, could again remain range bound, while there could be market interventions by the RBI expected on the higher side, which could help the currency above to trade below its record low and protect the business, also the benchmark bonds from falling sharply. The rupee had closed at around 88.66 levels last week against the US dollar, which is, while it had been up 0.1% on the week, have been supported by multiple dollar selling interventions by the central bank. Lackluster foreign trade portfolio outflows, persistent dollar demand from the local importers, and renewed strength in the dollar could prove again to be headwinds for the rupee in the near term. The local currency could trade in the range of 88.30 to 88.90 for this week, with a modest bias towards depreciation, while we have seen that RBI could continue to intervene as the foreign exchange reserves had declined by $5.6 billions to $689.7 billion as on October 31. So this is all about the updates for this week for commodities and currencies. I hope you have gone through its updates, and we wish you a very successful trading week ahead. Thank you very much.